हाँ हाँ एक सेकंड उसको मैं साइड कर दूँ. Good morning to everyone. So after a long gap, we are again back. We had been talking about options trading and various aspects of options. I will initially make some 5 minutes recap what we have already discussed, and then after that we will talk about various strategies. I think pricing has already been covered. Options pricing, how it has to be there and what pricing could be set. So just in recap, you have a look of it. Three things were there. First, there is a buyer and seller. Second, there has been call and put. And third, there has been two types of price: option premium, the price of option, and a strike price, the price of underlying, whatever underlying price is there. So that is set. Now, next to this, we know that depending upon the positions, it could be call option, it could be put option. One can write call option, one can buy call option. Writing call option is called short call, buying call option is called long call. Similarly, uh, buying put option is called long put, selling put option is called short put. And whatever underlying price is there is called a strike price or exercise price, and the price at which option is decided is called option price or option premium. Now, whether options will get exercised or not will depend upon the strike price and the then spot price when option is going to be exercised. The then means suppose December option is there on the expiry date, because we know in India we follow European option. European option is the option when it has to be exercised, it has to be exercised only on the day of expiry, whereas American option can get exercised on any day during the option period. This is what the American and European option is there. So in India it is European option. So if you want to exercise, it will be exercised only on the expiry date, not before that. So then a question arises, whether it should be exercised or not. It should be exercised if it is a call option and then a spot is bigger than a strike, then go and exercise the option. If it is put option, if a strike is bigger than a spot, exercise the option. Otherwise, let the option to expire. This is what we have already discussed. Then payoff over there, and the payoff as it is visible, it is something like K is the strike price, and the line which is there is actually a stock price, which is a spot price in true sense. And when it is going to get exercised, whatever difference between a spot and a strike will be there is going to be gain. It is going to be the profit or gain to the options holder or option buyer, and it is always from options buyer point of view. So as the price moves up, a stock price goes up, exercise will be there, and then whatever difference is going to get created is your profit. Reversal is the, it's a reverse part is the for short position holder. Whatever profit will be there to the option buyer, it will be a loss to the option seller. Okay. Similarly, when price reduces, then for put option it is going to be exercised and ultimately benefit will be there. Whereas reverse will be true to the option sellers, put option sellers, and it is going to be a loss. Now, this is without considering option premium. If we consider option premium, then in that case that this triangle will also be ready, and actually exercise will be taking place here itself, where is the K price, and but immediately gain will not be coming up. Gain will come up from that point where a strike price plus premium two together will be becoming smaller than the spot price. When a spot price crosses, this line is a spot price. So when a spot price crosses the combination of the two, then real gain is going to be there. And that is what the view has to be made. Now next to this is So various conditions has been specified here, and one can look into these conditions. Now, I have already shared these snapshots, and I had suggested you to go through with the real market conditions, whatever market conditions are there, whether it is NSE, BSE directly you can view, or you can view at money control or any of the those who are offering you the positions, and you can find out. And whenever this is CE or PE is there, CS stands for call options, you look into this, there is a C and P word is used. C is call, P is put, and E is always there. E is European option, because we don't have American option, so there is no CA, there is no PA. Okay. Then next to this is this is all various currency derivatives are also there, and snapshots you can take it. You can directly watch going to the site. Now move to the next point, how your positions will be there. Look here, I'm just crossing all these because these are the various things. Then we also discussed in the money, at the money, out the money. In the money, practically when option is going to get exercised and benefit is there, someone is gaining out of option, buyer is gaining out of it. When it will be gaining? When in call option, a spot price is going to be bigger than a strike price, the difference is going to be in. And if in put option, strike price is bigger than the spot price, then it is they are going to gain out of it. So whatever gain is there, if gain position is going to get created, it means there is in the money. In the money means there is a gain. If there is no gain and let the option to expire, it is out the money. Out the money means your benefit is not there by exercising the option, rather benefit is there when you exercise the, when you buy it from a spot market instead of exercising the option. And at the money, when you are indifferent, when both are going to be same, then it is at the money. That's the three condition, ITM, ATM and OTM is there. Next to this is time value. Time value is also very important. The option, we all know that as you move, as time passes, you are approaching to expiry period. So whatever premium is there, whatever discount is, whatever premium is there, that is actually having the time value. Bigger the period, higher the premium. And that's why, because more and more risk could be there. So time value, which is also called as extrinsic value, is the value of the options above the intrinsic value. So extrinsic value, there is an intrinsic value, inside value is there, extrinsic value, the external value, which is time value is there in the money or above the in the money area. Now in an options, whether a put or call is going to be out of the money by its expiration date, you can sell options in order to collect a time premium. Okay, the longer an option has before its expiration date, the more time it has to actually make a profit. So its premium or price is going to be higher, because so it is basically always directly related to the time frame. As the time is longer, more and more time value will be there. Time is shorter, time value will be lesser. Valuation is going to be set with this. Then so if an option has a lot of time before it expires, the more additional time value will be added to the premium. Now option pricings also has been done, and there are two different methods of pricings we discussed. One was the binomial pricing, another was the Black-Scholes model of the pricing. Binomial also had got single period pricing and 2 period pricing were there. Black-Scholes was also, and in both the cases we had used call and put option. Call and put options valuations has been made. So how the valuation has been set? Because binomial, you know that it's a tree is going to be there. I had already specified you the steps involved into it. In binomial, you will always find out there will be two conditions will be there. Suppose a price is right now say 1,000 rupees, so price may go 5% up or 5% down in a specified time. Because binomial, only two parts will be there. Then after that, you can have a strike price specified, because whenever we go for option premium or option pricing determination, we always have a strike price assumed or determined or predefined. A strike price is there. So a strike price is known to you, probable spot price is known to you, then in that case you can decide what is going to be your option premium. Option pricing is going to be set. So here the first step is that from the given information you can decide what is going to be your probability of the movement, and probability of the movement formula was there, P is equal to e to the power RT minus D upon U minus D, where U was the upward movement and D was downward movement. Had it been 10% upward movement, 1 plus 0.1 is 1.1, that was the value of U, and when it was a downward movement D, it was 1 minus 0.1, that is 0.9 is that. E was the exponential, R was the risk-free rate, T was the time frame, always in year. That is what we have already discussed. Once probability is known to you, then you have the have call options premium and put option premium formula. Particularly in the case of a binomial, both the formula are same, and P into FU plus 1 minus P into FD, and discount it to the present, you will get the premium. That's what the formula for premium using binomial. It was for single period. Had it been for 2 period formulations, then the move from right to left, right side, you use the same concept, same formula, come to the left point, and whatever value has come, that will be considered as FU and FD respectively, and then you again bring back to the present level, and you know that this is going to be one full question in your final examination. Whatever I explained, and this has already been numerical, has been solved in the classroom, so again reminding you to redo these calculations. Now come to the Black-Scholes model. In the Black-Scholes model, what happens? It's a very important and widely accepted model is there, and in that widely accepted model, it has been a difference between the then expected spot price and the whatever strike price has been specified. The then expected spot price is not very clearly and determined, so you can look into that. Whatever the volatility is there, whatever the deviation is there in from the present spot price will be considered as the next spot price, that is ST. ST means is the next one, so you can substitute ST by S0, that is the present spot, into whatever deviation is there, and so many deviations keep on fluctuating, so it is normalization of deviation. ND is there, and since deviation in the options market also we are considering, so we differentiate the deviation by tagging it with 1 and 2, that is D1 and D2. So S ND1 minus X ND2, but S, the moment you talk about, is in present, X is in the future, so you discount X also, so e to the power minus RT, apply it, you will get the call, reverse the positioning, you will get the put, and that is what. Now the challenge was there, how to calculate D. So D calculation was, D1 calculation was, we know that it is whatever relative valuation of a spot and futures price are there in natural log of that, ln you take it, plus R is the risk-free rate, plus half of sigma square into T upon sigma root T. Your sigma is volatility is available, so you look into your D is the function of volatility, time, risk-free rate, and the two prices, that is strike and spot price. These are the functions. So it is determinant. They determine what the price is going to be there. And if minutely observe, you will find out everyone's behavior is captured there. Market behavior is captured, price determination is captured, through our government behavior is captured, and so on. So this is what ultimately pricing has been set. Now this is the formula which we were talking about right now, and since we have already done in length with numerical question, so please consider very obvious and important question. Now let's move. This is what for D1 to converting into ND1, and negative and positive two valuations could be there. So be very careful when you are looking into the table. Negative values are there, D1, D2, then you can use negative one. So there also it is written X is less than equal to 0, where you will find out is this side also you can cross check, it is negative. Negative values are there. So use it. Now we will go for another concept, and that concept is called put call parity. What is put call parity? Actually, it is always there that in the market, whenever we consider whether call and put, two are there, are they same? If suppose more and more call is coming up, it means market is at a lower price, price is expected to move up. Or more and more put is there, put pressure is there, then in that case people are looking for that price will go down, and that's why they are going for put option. So it's a balanced market is always there when it is put call parity is going to take place. Parity means equality is going to take place. So the moment we talk about parity equality, you will find out there is a formula, put value plus a spot price should be equal to present value of a strike till maturity plus call value. That's the equation is going to be there. So put value means whatever sales value is there and a spot price. So today and future sales value is equal to whatever the present value of a strike is there and call value is there. So this is, you look into that, P plus S is equal to K e to the power minus RT, because it is the present value of K, strike price plus call. Both the put and call are ATM options. That's what the conditions are there, assumptions are there. Both the put and call are ATM options. The options are European, because that is actually we follow European options in India. They both expire at the same time. When expire on the same time means there is no horizontal spread. If it is a December options, so both are put and call are December options. If it is a January options, then both are January options. And the options are held till expiry, means there is no one is going to exchange or no one is going to buy and sell well before that. So that is what it is used. If you hold the present value of the strike and hold the same to maturity, you will get the value of a strike itself. Hence the above can be further restated as put option plus a spot price is equal to a strike plus call options. So it is actually, if you are holding it, so what it says that then there is no requirement of making it a present value, and when you are not making it as a present value, so whatever a strike price is there, you don't require to make present value of a strike price. So simply write a strike price plus call option. So if you minutely look upon, that's a very important point. A question arises here, why equity should hold? Equity means why put and call parity, or why put and call equity should take place, how it is a balanced one taking place. So it says, assume there are two traders, trader A and B. Trader A holds ATM put option. Now keep this formula in your brain, where put plus a spot is equal to call plus a strike, right? Put plus a spot is equal to call plus a strike. This is what the parity has to be proved. So it says, let's say trader A and trader B. Trader A holds ATM put option and one share of the underlying put plus a spot. So a spot means one share, one underlying, that is what it is there. So put option is there and one share is there. When put option is there and holder, what is put option? Ultimately you have the right to sell, and you have underlying. So you have an underlying and you can sell that. What is B holds call option? Right to buy, and cash is holding. There is a cash holding. So cash amount equivalent to the strike price. Whatever strike price is there, you are holding. When it is there, you can buy it. So two asset, one asset is derivative asset. A is holding, that is put option is holding, and one stock is holding. B is also holding two asset. One is derivative option, that is call, and another is cash. Both are there. If anyone is having a better position, means parity is not there. And if both are going to be in same position, then parity is maintained. Parity means equality is maintained. So look into how it is going to work. So traders B holds a call, traders A holds a put. This being the case, as per the PCP, put call parity, the amount of money both traders makes should be same. The moment there is a preference in any of the position, then in that case that parity is not hold. Look into it. Suppose underlying is Infosys. This is what the illustration we are trying to evaluate. Underlying is Infosys. Price is, let's say, strike is 1200, spot is also 1200. Whatever the spot price is there, at that price itself a strike has been written. A strike is also there. Now Trader A was holding put plus one stock. So 1200 PE, clear, put option, European, plus one share of Infosys, that is also of 1200. Trader B holds 1200 call option and 1200 cash. One is holding share, another is cash. Now assume upon expiry, Infosys expires at 1100. Infosys has moved from 1200, it has moved to 1100. This is what the position has been made. Now look into whether this is both the party has got equal position or not because of price movement. You can make any price movement, 1100, 1300, 1700, 10,000, whatever you want to make it. So let's say at 1100, what trader A will do? Trader A has got 1200 put option. Means trader A will exercise it. Yes or not? Will exercise. To exercise, then how much amount will be coming up? 1200. 1200. But now trader has got one stock also. A stock is how much? 1200. And now a stock price is how much? So what is the value of a stock now? 1100. 1100. Is it clear? So trader A put option becomes profitable and 100 rupees is earning. Market price is 1100. 100 rupees is earning. Clear? And here 100 rupees is a loss. Right? However, he loses 100 on the stock that he holds. Hence, his net payoff is what? 1100 plus 100, 1200. Position is back. Right or not? Whereas a B, now 1200 is a call option. Will he exercise the option? Yes or no? Call option, will he exercise? No. If he go and exercise, he has to pay 1200. In open market, it is 1100. So when it is available in open market, in a spot market at 1100, why you will be exercising the option at 1200? So will not exercise. Is it clear or not? At what price he will buy? Let the option to expire. Option will expire. No exercising option, because option exercising will require to pay 1200 rupees. And same share is available in a spot market at 1100 rupees. So you will not exercise the option, let the option to expire, and you will get at 1100. So your 1200 value become 1100. Now how much you have got? You had cash reserve 1200. So 100 cash is left and you got a share also. Is that clear? And 100 is left. So you have got 1100 rupees worth of the equity shares and 100 cash. Again your net position is 1200. Even put option holder net position was 1200. So position is maintained. That's the way it is. Is it clear? So put call parity, maybe 5 marks question. Prove that put call parity holds. Also explain if it deviates, why it will deviate. Is it clear? Why it will deviate. Parity holds or not holds, two conditions are there. So these two conditions ultimately has to be viewed. Am I clear? One thing always keep in mind, your final examination, whatever is been discussed in the class will come. It's very clear. So no confusion. Keep focusing on your class preparation. Let's move further. Now suppose it is 1350 instead of 1100. See, at 1200 we had taken, we reduce it to 1100, now we are making it to 1350. Then really we look into that side, holding is there or not, what is going to be set. Now if you have a put option at 1200 and market price is 1350, will you be exercising the option? No. Why you will go and you will get only 1200 if you exercise the option. Open market it is available at 1350. So I'll go and sell in open market. So let that option to expire. Put option you expire and you will get from market 1350. Right? Clear? So options gain is 0. Nothing comes from options. But you had one share also. Okay, 1350. Shares was 1200, now it is 1350. So 150 is again. Put option you will not be exercising. And 1350 is there. So that is what you look into. Trader A, put goes 0 and a stock goes 1350. Okay. Trader B, call values goes to 150. Yes or not? Because call was also at 1200. So 150 will be gain on the call as well. So call will be 150 and plus 1200 cash you had already got. So making it how much? 1350. In both the cases it is going to be 1350. So what it indicates? So clearly irrespective of whether a stock, where at what price the stock expires, it doesn't make any difference. Ultimately, the equation holds true, meaning both trader A and trader B end up making the same amount of money. And if it is holding, if it's of that nature, then in that case, put call parity is maintained. PCP is maintained. Okay? And one more important point, generally it is one of the very strong indicator in the market. We say PCR. PCR stands for put call ratio. If put call ratio is more or less closer to 1, means market is balanced. Put call ratio closer to 1, market is balanced, and accordingly it is viewed. So that's why PCR is a very important ratio. The way price earning multiples are also important related to a particular instrument's price movement, particular company's price movement, exactly on the same way. This is also very important. Okay. So that's one small portion but very important portion. Now the final leg of the options positions we are discussing. So we discussed entire concepts of options starting from various terminology. Then we discussed pricing of the options, and now we are going to discuss a strategy of the option. A strategy is numerous, n number of strategies could be there. Initially, I will make you understand related to a strategy. 3 things are there in the strategy. Basic strategies are only 4, which I had mentioned in the beginning also, in the previous sessions. What the basic strategies are? 2 position holders are there, long position holder and short position holder. Long position holder means buyer of the option, short position holder means writer of the option, seller of the options. 2 products are there, call and put. So combination of these 2 into 2 making 2 into 2 matrix 4 products. Long call, long put, short call, short put. These are the only 4 strategies. And these are the only strategies. This also I mentioned during my earlier class to you, when first class of options were there. These are the only 4 options. Then what is this various strategies? And when I am saying n number of strategies taking place, what exactly it means? It means now you will start creating combination. Are you getting me? And if I remind you that what illustration I had given you at that point of time was color. There are 3 primary colors only, BGR. And then after that you make 7 colors with Geo, and then you go to development of an example had given Asian Paints and others. Thousands of color shades are there. Actually those colors are not primarily existing. Yes or not? Those colors are not primarily existing. Am I right? So exactly on the same way, These strategies, when we talk about, these strategies are actually the combination of various strategies. Only 4 strategies are there. Like in financial accounting also I can give you a synonym. And what happens in financial accounting? There are only 2 entry. One is debit, another is credit. There is no third entry. Only debit and credit entries are there. And there are only 3 types of accounts. Okay? Nominal account, personal account, real account. Matrix become 3 into 2, 6. Story over. No other accounting entries are there. Whatever various transactions are there, you have to deliberately bring back in one of the 6 box. Right or not? That is there. And the moment you have to have a double entry system, you have to get reflected into 2 sides. Compulsorily it has to be there. Saying so, now it is very clear, when we are going to have strategies, it is combination. Right? So let's recap once again basic strategies, which is long call. Now question is, why anybody will go for long call? What is the need of going for long call? So long means option buyer who will be paying premium. So a basic mindset is that when you are expecting the price of underlying is going to move up, and you are going to require that, means you are going to buy that underlying. Not now, in future. You need that underlying. Suppose I decided to buy a share after 2 months of time. And right now I can't buy. I decided to buy after 2 months of time. And it is expected that after 2 months of time the share price will move up. So now my concern is, if share price will move up, it will become costlier. I can't buy now. Maybe my arrear is expected to be released after 2 months of time, and that money I want to park. So right now I don't have money, even if share price is there. So what to do? Importer has to make payment after some months. At that point of time require currency. So then in that case, if it is expected to move up, what you are required to do? You are required to go for call option. Buy call option by paying a small amount. Call option premium. You are holding your net position. Suppose 83 rupees is the price of USD and expected to move to 84 in 1 month of time or 2 months of time. By paying 25 paisa of premium at 83 rupees, I am blocking my call option, say at 83 rupees 40 paisa. Means my ultimate outflow is decided at 83 rupees 40 paisa plus 25 paisa, 83 rupees 65 paisa. What is the best part of it? If as per my expectation it crosses 83.65, my ultimately net gain will be there. Net cash flow will be there. Right? And if it is lower, suppose my expectation fails and price remains low, then in that case I will be gaining from the low price. I will not exercise option. If suppose it is lesser than 83.40, then I will take it from market and let the option to expire. Clear? That is what it is. So then a question arises that what ought to be the strike price? Who will determine it? Will it be the option buyer or option seller? So we know that payoff is going to be by always from option buyer's point of view, but pricing is always determined from the option seller's point of view. Price is always determined by them. So when price is determined by them, then an option requires how it is going to be made. it is requiring that thumb rule could be there. Option seller will always be looking into that, make strike as high as possible, especially the call price, call a strike as high as possible so that it should not be exercised. If seller is expecting that price will not move beyond 83.50 in a specified time frame, then in that case, let's make a strike price of 83.50 with say premium of 5 paisa or 10 paisa, which will be your net gain, because you know that 83.50 it will not reach, option will not get exercised, and whatever premium you are receiving upfront ab initio, that will become your pure gain. If suppose you feel that it may go up to 83.50, but you are writing on a strike at 83.40, means there will be a 10 paisa gap, and that 10 paisa gap you can gain out of it by putting option premium. So 15 paisa, 20 paisa, and it is that combinations of a strike price and expected a spot price, and that difference which is going to be the option premium, we have already done in the option pricing techniques, both in binomial method and Black-Scholes method. We have used it S minus X practically, or even in D1 calculation S upon X, that was ln S upon X was there. So these calculations ultimately indicates whatever the differential of the price is there, that has to be used for determining whatever the option premium is going to be. That's the way it is to be. But now question is, in real life it is not that straightforward. If I say that option is, underlying is expected to move up, say in example USD is expected to move up, but there is a term I am using, say 70% chances price will go up, 10% chances price will come down, 20% chances price will be in between only, in near range only, then what will happen? Or suppose a straightforward dichotomy I create, and in that dichotomy, say 70% upward movement is there and 30% downward movement is there. If I say for 70% upward movement, I make a strike price on a higher side, but what about if it is going to be downside? Am I protecting myself from the downward movement? Or if there is a gain opportunity because of downward movement, am I taking any position right now? And from here, combination starts. So basically a strategy is that it is not only what you do, most important part is why you are doing so. Why you basically make that combination. That is very important. That is the part of strategies. So here you look upon actually various conditions are there. So broadly depending on the market perception, market condition or market expectation, three categories bullish, bearish and neutral has been set. And if it is market is expected to be bullish, what kind of a strategy you will adopt there? If it is bearish, what kind of a strategy will be there? And if it is neutral, what kind of a strategy will be there? That is what it is specified. Now come to the actual examination question. Because a number of strategy can be used, some of the common strategies we will study, and I'll suggest the way you should develop more strategies so that you can prepare accordingly. And any of the strategy comes, or if any explanation is there, you can make it. But some obvious strategy you have to prepare, you have to develop. Look here, it's a bull call spread, bull put spread. Whenever we say bull means market is expected to be bullish, price is going to be high. Similarly, reverse is bearish. Okay. Call ratio, back spread, bear call ladder, call butterfly, synthetic call, straps, strips, straddle, strangle, condor, box, a number of strategies are there. Various strategies are there, where you are actually creating a combination. What should be your learning style? First, whatever the examination will be always asking you the common one. whatever common strategies are there. Some of the obvious common strategies you have to use. That is your first thing. Second, means definition of a strategy itself. What is definition of a strategy? What exactly you do in that strategy? If suppose butterfly is there, what exactly this butterfly stands for? Okay. And long butterfly, short butterfly, if it is there, what exactly it means? Strad is there, strap is there, strangle is there, strangle is there, what exactly it means, what this is, okay? Or spread is there, what exactly it is. So, concept you have to write, first thing. So, maybe one long, one short, one call, one put, two call, one put, maybe ratio, calendar. Okay, so that definition is very important. That time being to start with, you can mug it up. But simple mugging will let you more into confusion. So what best way is that? Draw diagram. What exactly you are doing. So how you can classify, how you can compartment in your brain. Okay, now it is very clear whatever strategies we are going to talk, it is not a single position. Like long call is a single position. Long put is a single position, outright position. Only one thing you are taking. So now it is sure that all strategies have got more than one. So you can make it where you are taking two positions. All two positions you can classify accordingly. You are taking three positions. You are taking four positions. That is there. So 2, 3, 4 positions you have normally to study in examination. Now, definition, that is a theoretical question will be coming up. But here, the net cash flow has to be met. If suppose two long position you are taking, so 2 times premium you will be paying. And certainly it is not double of the same long call, it is two long call means two different long calls are there. Maybe for same underlying, for same expiry. Underlying also has got a variety. Understand, some terminology has to be very clear. And repeatedly I am going to repeat it again and again just because that concept is clear, then only you will be able to understand, appreciate and appropriately write that. Okay. So what is very important is that if it is 2, then why 2? Means first is that you have write that definition. Second is that what the position you are going to take. Third, why these positions are going to be taken. And next step is illustration. Illustration means if any price is going to change, how you are going to get gain out of it. If price moves up, then what will happen? If price fall down, then what will happen to you? What kind of net position is going to be? What is your maximum loss or maximum gain could be possible there? And that is what you have to create. This is what we are going to study here. Okay. So it says that spread. Spread means what? Spread means a stretch. And whenever a spread or stretch is there, how to create an image related to it? There must be 2 points. Yes or not? A spread can't be there until unless 2 point is not there. So a spread must be 2 point, means 2 positions, gap of the 2, maybe 2 product. Between that, whatever gap is there, you can say spread is basically a difference. Quotations we had discussed, bid-ask spread, bankers spread. Another paper we were talking, that spread was the bankers earning. Clear? Exactly that is spread. Bull call spread. This is what the word written. Call spread. 2 call must be there at least. Then only a spread will be coming up. Right? Just try to peep up so that your learning will be better. Bull call means it must be in a bullish market. Call normally refers to bullish market. Then only we will be looking into it. Put normally refers to the bearish market. That's the way it is working. So whenever we talk about bull call spread, look into one how it is going to work. Every strategy has not been explained. Be very clear. every strategy has not been explained. Some strategy has been explained as a matter of citation and explanation. Rest you have to study from your book. Okay, rest. So learn the pattern, how it is going to work. Okay, look into it. A spread is the result of simultaneously two or more options positions. Bull call spread is for an outlook of moderate and not really aggressive movement in the underlying. Aggressive movement is not there. Moderate movement is there. It may be moderately bullish or moderately bearish, either of the side. So now you create a spread strategy to you protect yourself on the downside. Means in case you are proved wrong, what is your expectation? Price is moving up. And pata chala gir gaya niche. That is the downside. Are you ready to have it? Is it clear or not? That is the way we are actually looking into that. When we climb up, we put a rope with us so that it will be saving us when we fall. Am I clear? Exactly the same concept we are going to apply. So you protect. The amount of profit that you make is also predefined, capped, because both the sides are there. Amount of profit is capped. As a trade-off, for capping your profit, you get to participate in the market for a lesser cost. How you are going to work it? What kind of things it is going to make? The bull call spread is a two-leg spread strategy traditionally involving ATM and OTM options. However, you can create the bull call spread using other strikes as well. Anyway, leave that however part. First look into buy one ATM call, sell one OTM call. Means you are buying ATM call, right? Now ITM, ATM, OTM, all the terms has been frequently used in number of sessions. So you know, even in the morning I revised. So buy one ATM call, sell one OTM call, buy long call, short call. Means you are taking a long call also, you are making a short call also. Two call options. LC and SC2 together you are making. Understanding that. Before going to it, some of the features has to be ensured and it is normally assumed to be there. So all strikes belong to the same underlying. Same underlying means if I am talking Infosys, then it is for Infosys, both long call and short call, both for Infosys. If I am talking USD, then it is for USD, means underlying is same. Second important point, same expiry series, means if I am talking December Infosys, then December Infosys. I am talking December USD, then December USD, means the expiry will be December in both, same expiry. Yes, whenever we talk about that spread, three terms are there. First term is called vertical spread, second one is called horizontal spread, and third one is called diagonal spread. Okay, understand these three terms. When we say vertical spread, what is this? When you make a graph, x, y axis, x is always talking about time. Whenever time price graph is there, time will be always on x-axis. Time is an independent factor. Normal trend in the graphing is, if you have independent versus dependent variables, independent should go on x-axis. That's the normal thumb rule. Time is always on x-axis. And y-axis will give you the another parameter. Say here in price, whatever price is there. So time is there means suppose I am making a time, November, December, January, February, and like that, we can keep on making the times. When both the products are same month, say we are talking about December expiry, so December expiry long call is December, short call is December, both are December, so both are coming at the same point. On x-axis at the same point, that is on December. So there is no deviation in the product on the x-axis. But they will have a different price. Yes or not? And price is reflected on y-axis, which is a vertical in nature. So that difference is actually creating the vertical spread. Price spread is a vertical spread. Time spread is a horizontal spread. If suppose in one of the strategy I make one product in December expiry, another product in January expiry, I can take it. Then where the spread I am creating, now on time frame I am creating a spread. That is called horizontal spread. Because one of my product will be standing at December, another will be standing at January. There will be a gap in the horizontal one. I can create it. How that strategy will be there? Ultimately, why is very important. Why you are going to create that? But we can create it. And if suppose both are at the same price, it will become a pure horizontal spread. So vertical spread have got the price difference, but no time gap. Time difference is there, but no price gap. So first one was vertical, second one is horizontal. If suppose both difference is there, time difference is also there and price difference is also there, what will happen? Angle will be like this. One arm will be this, one another arm will be this, so you will have a diagonal one. Diagonal spread will get created. Is it clear? All the possible conditions could be possible. And diagonal not necessarily to be always on the upward swing, it could be downward slope also could be there. But it can't be a rooftop, plain rooftop, it could be a slant. That is what diagonal is going to take place. So depending upon what kind of condition you are going to create. So three important factors are there. First one is economic condition, which is bull, bear, like that market movement. Second one is the strategy involved into it. And third one, gain or loss out of it. What kind of gain loss? Your answer is perfect. If it is for one small strategy, 5 marks, 5 marks complete. As a portion, you simply written definition, and story, definition correct, maybe 1.5 or 2 marks out of 5. You are thinking I have written bull spread, but marks out of 5 is 2. Later on complain, sir हमने तो पूरा लिखा था. साहब आपके 3 कंपोनेंट हैं उसमें, आपने एक कंपोनेंट. What will be the reply? Answer was correct but insufficient. That's why you got only 2 out of 5. You wrote all 3 components, 5 out of 5. That's the way you have to be very careful. Okay, so how you are going to make this? Let's understand. One more question before moving ahead. I am trying to engage you in the class. Now let me, your LC is there. Okay, I will first remove the slide from here. Then after that I will talk, because answer is lying there. Long call is there, short call is there. Long call was ATM, short call was OTM. That was written. Long call was ATM, short call was OTM. Long call you will pay premium, short call you will receive premium. Long position holder always pay premium. Short position holder receive premium. Now question is, the amount of premium you will be paying when you enter in long call and the amount of premium you will be receiving entering short call, will you be net paying or net receiving? What will be your net position? Means premium paid will be bigger than premium received or vice versa, or both premium will be equal because both are call option. Same expiry. Actually answer was written on that slide indirectly. That's why I have shifted the slide. I expect from you. Again, answer I have already mentioned, still you have to make it. Okay, just to understand, if I am expecting price will be 83.50, USD can move up to 83.50, and I am writing an option, or I am creating a strike price of 83.30, 83.40, 83.50. Is it clear? 3 strike price I am giving you example. I am writing, I am expecting, my expectation is 83.50 will be the maximum price. Price will move up to 83.50. Of course, you know I am referring USD in my mind. Now 83.30 when you are writing, how much premium you will charge. 83.40 you will be writing how much premium you will charge. 83.50 you will be writing how much premium you will charge. Where premium will be more? 30 premium will be higher. Is it clear? So as a strike price moves up of a call option, premium will reduce. Yes or not? Clear? This concept, any doubt here? Price moves up, premium will come down. Price moves up means you will be slowly going towards OTM. Am I right? First it will be ITM, then ATM, then OTM. Here message says you, question says you that you buy a call at ATM and sell a call at OTM. इसका मतलब क्या होगा? When you are buying the call, you will be paying premium, must be higher. Yes or not? Paying premium must be higher. And selling the call, premium will be lower. So net premium will be an outflow. Right or not? Net premium will be an outflow. So in the bull call spread, where the answer is written, why I look in that? Look into that. K1 and K2 I have already written there. And on the line, if you make it, K2 has to be higher than K1. And when K2 is to be higher than K1, then then the options premium will be lower. Premium will be higher on K1, lower on K2. Higher on K1 and you are buying K1, so you will be paying premium, higher premium, and you will be receiving lower premium. Right? That's the strategy you are going to develop. So each leg involves the same number of options, 1:1 ratio. If 100 USD you are, one lot you are making a call option, one lot you are making a long call, one lot you are making a short call. So that volume wise same, 1:1 ratio. Now example, here we are created, say 23rd November, outlook means what you are expecting, how you are expecting the market. It says moderately bullish, expect the market to go higher, but the expiry around the corner could limit the upside movement. Nifty spot, older example is there, that's why Nifty spot older value has been written, 10,846, ATM 10,800, OTM 10,900, 10,800 premium was 79, 10,900 premium was 25. Okay? You buy a call option at 79 by paying 79 and you sell a call option by receiving 25. Difference of the two is how much? 54. So 54 is your net outflow. Is it clear? Now, generally speaking, a bull call spread, there is always a net debit. Because always you will do, long call you will always be taking at a K1 and short call you will be making at K2. So always you will be paying the premium higher than receiving your premium. So then in that case, always your premium will be net debit. And that's why bull call is considered to be a net debit environment. Is it clear? Now, scenario 1. So price you remember, 10,800 Nifty has been purchased, long call. 10,900 it has been sold, short call. 79 was the premium paid, 25 was the premium received. Information is that should be in your brain. Now move here. Suppose on the expiry date, Nifty comes to 10,700. What will happen? Now, before actual calculation, I will show you the style of writing. This is the style of writing. How you will prepare your answer. Until unless you prepare like this, your answer clarity will not be there and your chances of committing mistake will be very high. So tabular presentation is must. Is it clear? Tabular presentation is must. That's the way you will be preparing. Right? How directly I am coming here instead of explaining, because whatever written in between I will be keep on speaking. Okay. Look here. Whatever intrinsic value is there, and you will find here this is what your what do you say, whatever the explanation is there of the terminology which this abbreviation has been used. So it's a glossary. So LS stands lower strike price, that was K1. Higher strike price, K2. Lower strike intrinsic value, okay, PP is premium paid. LS payoff is payoff from lower strike. HS again for the same thing. Let's market condition I have taken from 10,000 to 11,400. Okay, that's very important. Now, how many positions you have taken? Suppose you have the two positions. One is long call, another is short call. Time being, ignore the premium, because premium is a sunk cost. Actual way you will strike, you will exercise, not exercise has to be taken. And very comfortably, why I am suggesting you, don't get any kind of disturbance because of various strategies, because there will be four strategies also, four positions will also be there. Like when we go to box, condor, butterfly, there are four conditions. Price could also be K1, K2, K3, K4, and then you have to be very careful. But I am a very simple way to learning. I suggest you make 4 columns and always take one at a one time. No one is compelling you, no one is standing on your head during writing examination that show me your the relativity. Just you pick one, answer one. Pick two, answer two. Never ever you will commit mistake. And full marks. There's a very scoring paper. Very scoring paper. Not only that, you will understand strategy better. And if you start writing the language and all four together, you will always commit a mistake. So here I'll go only for LC first. LC column first. Yes or not? LC at what price? 10,800. Very good. 10,800. What is your market expiry? 10,000. Now you think of your LC means long call. Strike price is 10,800. Will you exercise? No. When it is openly available 10,000, well, I'll go and exercise at 10,800. Yes or not? So directly from there till 10,800, is there any kind of a gain to you? No. One stroke, come to 10,800. Filled up. Clear? Zero? Any doubt in this? No. Now it is 10,000 zero. Actually, we can consider this also as one of the condition. One of the condition. 10,800. You whether exercise or not exercise, it is same. Exercise, then also you have to have it 10,800. You have to pay for having your index. And if you don't exercise, then also 10,800. So it is zero level. What is your net cash outflow? Oh no. Only one strategy right now. Have you done mathematics, partial derivation? Fragments, 79. Throughout 79, उसमें तो कोई डाउट ही नहीं है. एक्सरसाइज करो ना करो वो तो गया, संक कॉस्ट अभी बताया. वो ये कॉलम तो आप ऐसे ही भर दोगे. प्रैक्टिकली सच पूछो, ये आप लोगों के लिए बनाया, मैं तो अपना ये कॉलम कभी बनाता ही नहीं. जब एक ही बार बार करना है तो ऊपर एक टॉप में अलग से एक लिख दो 79, उधर से कर दो, और -54 इज द अल्टीमेट आउटफ्लो. Yes or not? -54 is going to be there. But anyway, for better understanding, you make it. Now what happens? You go to 10,900. Recall the graph. What is happening? It is positive. As the price moves up, you are gaining. Because market has got 10,900, you can buy at 10,800, 100 rupees is gain. Market is 11,000. 11,000, you have 200. Market is at 11,400, you have 600. Market is at 12,000, you will have 1,200 of the gain. Yes or not? As market moves up, you have a gain. And that's why we say unlimited gain could be possible if you have got a long call. Right? Net outflow. So the moment we talk about 100 minus 79, it is 21. And from here, you have got unlimited gain. LC complete. No challenge. It's actually a separate one component. Now simultaneously you make SC. Here the situation will be different. SC means what? You are writer. So you will be receiving how much? 25. Positive 25. Come to you. But now look into, if market has got 10,000 price, what will happen? Think of. Now your style of thinking will be changed. Should be changed. What? Now it is not you who will decide. You are a short position holder. The person who have taken long position from you will decide. So you have sold, you have written, what is your strike price of SC? 10,900. Yes or not? 10,900. So unless market crosses 10,900, will that person come and exercise? No. उसके लिए भी तो open market है ना? Yes or not? So at that price, that party will also not be exercising. Till which level? 10,900. But the moment it crosses, then in that case, he will exercise that, and his gain is your loss. And since you are SC, short call, your loss will be wider. Keep on widening. Your loss will keep on increasing. Right or not? Here. But 25 you have already gained. So your net position will be there. Now this column and this positive column, this you add. So ultimately what will happen? If you add from top 0, 0, 0, so minus 79 plus 25 is up to here, how much? Minus 54. But here it is positive 46.
10,900.
Positive 46. And it will remain positive 46 throughout. Remain positive 46 throughout. Why it will remain positive 46 throughout? Because you will feel here that what is your condition? Bullish. Right? So it will keep on moving up. And your whatever market will move up, it will give you positive. But if unfortunately market comes down, you will have a loss. But you are protecting yourself, a safety valve, your loss will never be more than 54. So negative. Let the market to fall, your 54 could not be there. How to now perceive it? I hope the calculation you must have seen, multi-column table, multi-row, multi-column table, but it is very easy table. And now it is, if it is 2, you can make 3 also. You can make 4 also. Easily, and net effect can be easily viewed. Clear? Easily it can be viewed. Now what is happening here? One more important point, that 100 rupees is the difference between two strike. 10,900 and 10,800. So two strike spread is 100 rupees. Right? Second, the difference between two premium is 54, but unfortunately minus 54. So 100 is maximum gain you can take because of difference of a strike, and minus 54 is your loss. So your maximum gain could be 46. If you want to increase or decrease this, accordingly you decide price. A strategy is going to give you this. Yes or not? If you are able to make it, say instead of 10,800, one side 10,800, another side 11,000, 200 difference, 200 minus 54, so 146 is going to be your maximum gain. Or if you instead of 79, you can make it say 29 and here 25, then in that case only 4 rupees will be your loss. So that you decide. But the subject is that you have to make sure that product should be available in the market. Right? This is what we'll call a spread. I hope very obvious question, one question numerical on the option premium calculation, maybe Black-Scholes or maybe binomial. Even I don't know which one will come where, because one set will carry Black-Scholes, another set will carry binomial. आपके फेट में जो सेट आ गया, दो सेट क्वेश्चन में जो सेट मिल गया आपको सॉल्व करना है. Now another here, this question will be coming up, it's called. अब ये समझ में आई बातें कितना, और ये फुल क्वेश्चन के लायक लग रहा है. डिफिनेशन से स्टार्ट करके और प्राइस स्ट्रेटजी नेट गेन कैलकुलेट करना, टेबुलर प्रेजेंटेशन, एक कंप्लीट क्वेश्चन बन रहा है. ग्राफ बनाना पड़ेगा. सो लुक देयर. लॉस इज लिमिटेड. यहां क्या होगा, ये माइनस कितने 54. Gain is limited, 46. Graph is also very simple. But here, two graphs you have to make. One graph will be for LC, another for SC. Okay? That graph has to be made. And you can easily view. I hope the points are clear. Let's move next. Similarly, put a spread could be there. With the put part, you can easily view it and you can find out how put part could be set for your self-study. And this is the way. Actual graph which I says that you have to make this, you have to make that, and then net effect will be coming up. Okay. Both way it is there. I am crossing it because you know how to create it. You have the fair idea now and your practice will make it. Same way, here it's only one difference I'll try to make you. But look here, you are buying OTM, selling ITM. Selling ITM means lower price. Selling ITM, more premium will be coming to you. Buying OTM, lesser premium will be going from you, so you will have a gain out of premium. And gain out of premium, if you look into illustration, you will find out here we have taken buy by paying 72 of the premium, that is written at 10,700, sell at 10,900, entering into 163. Is it clear? So 163 you are receiving, 72 you are paying, ultimately 91 is your positive, it is your net inflow. Since it is net inflow, it will be called as net credit item. Okay? This is what the tabular you can create, you can find out, you can make it. And the view can get created. Yeah. Beer spread is also an assignment, but not for you. You people do your self-assignment self-learning, box spread. Now, strategy will be there and how it is going to work. Let me see whether, yeah, butterfly is also there, so I'll discuss afterward. Both are very important, and in examination, bull or bear, anyone can come. Okay? Box or butterfly, anyone can come. And maybe in short notes kind of things, a straddle, straggle, or strandle, strack, strip, anything can come. So look here how the box is spread. Now, right now, how many positions you were taking? 2. Now we'll take 4 positions. 4 positions will take at the box. Okay? How you will make those 4 positions? Maybe K1, K2, K3, K4. Before this, more important, I'll take a butterfly also. Then I'll come to box. First, let's butterfly. This also has got a 4 positions. K1, K2, K3, K4. Now, what you do, you take long position also and you take short position also. You take 2 long positions at different price, same expiry. Take 2 short positions at a third price, a different price, same expiry. We are not changing. The moment we will change expiry, our strategy will be called different, and that is called calendar spread. Calendar means what? Time. That's the way to remember. The moment there is a calendar spread means it must be a different expiry product is now coming up. Here we are talking about price spread, vertical spread. And vertical spread is always with the same expiry. Price different, K1, K2, K3, K4, price different. But all are say December expiry or January expiry. So it is always a kind of a vertical spread is coming up. So now look here. Suppose this is the price. Okay. Then what happens? If I make a shape like this, this is a shape I created. Now what happens here? This is a price, this is a price, this is a price. 3 prices. This is a x-axis, this is a y-axis. Downside negative, upside positive. Okay. What is happening here? 4 strategy you are taking. Long call, 2 long call, 2 short call. Okay. When you talk about 2 long call, okay, what happens? Let's take first long call. Price is here K1, K2, K3. 3 prices are there. K1, K2, K3. Like in our example, Nifty was running. The present example which we were showing, it may be 10,800, 10,900, 11,000. 3 prices are there. They are a strike price we are talking. K is a strike price. So K1, K2, K3. You take 1 position here, you take 1 position here, and you take 2 position here. Means 1 position on K1, 1 position on K3, and 2 positions on K2. And understand that whatever position you are taking on K1, same position you take on K3. What it means? If I am taking a long call on K1 I will take long call on K3 also. 2 long call. 1 long call on K1, 1 long call on K3, 2 short call on K2. Or reverse could also be possible. 1 short call on K1, 1 short call on K3, 2 long call on K2. If terminal is long, it will be called as long butterfly. If terminal is short, it is called short butterfly. Clear? How many price is there in butterfly? Butterfly is what? That's one is love. You know, butterfly, that's a keep on flying. Not in Delhi. Delhi is not suitable to them. Okay? But certainly you go to those areas where good flowers and greeneries are there and hilly areas are there, you will find out butterflies available. Butterfly, when sit down, then body is there and they just have the wing flat. Flat wings are there. That shape is similarity. Okay? So that is 2 points. And in between the body. Okay? It could be inverted, it could be that. Right? So this is a kind of, when we talk about price is lower and there is a loss, it must be long call. Yes or not? So it is inverted one. Normally it is not given in your even John C. Hull. Just as John C. Hull also writes with some other authors has given, John C. Hull always talks about short butterfly. Short butterfly will be in a reverse order. What is short butterfly? Why short will be reverse and why long will be this way? If I have to make a short butterfly will be like this. Why it is so? Tell me. Any one of you? K1, K3 short call. Okay. So then, but this is also, I can call it K1, K3 short call. Then loss. Then what it mean? What it mean? Tell me. Yes, you are trying to understand and you are trying to speak properly, but still clarity is missing. Why so? Any one of you, please. Why this is a short butterfly and this is a long butterfly? Why it is so? One answer is correct. Yes, that I have already defined you. When 2 terminals are short, it is called short butterfly. 2 terminals are long, it is called long butterfly. But by looking at, how can you view it if I have not spoken? How you can wait? Very simple. Very simple. In short call, what happens? Will you receive premium or will pay premium? Receive premium. So receiving premium will be positive or negative? Positive. So premium should be positive. देखो premium positive किसमें है? नीचे वाले में. Yes or not? Premium positive नीचे वाले में है. यहाँ positive है. इसका मतलब आप receive कर रहे हो. Am I clear? और बीच में pay कर रहे हो. इसलिए वो नीचे चला आया है. Long call. That's a simple way to view. माना अब अगर इस तरह से ब्रेन में रहेगा तो फिगर एग्जाम में उल्टा नहीं बनेगा, है ना? घबराहट नहीं होगी, उल्टा नहीं फिगर बनेगा, आराम से बना पाओगे. और अगर ये क्लैरिटी नहीं है तो मालूम हुआ लॉन्ग बटरफ्लाई की जगह शॉर्ट बटरफ्लाई बना के चले आए. कभी फॉर्चुनेसी होती है, आप लोगों का कॉपी इतना है कि अगर किसी इवेल्युएटर ने इग्नोर कर दिया तो मार्क्स मिल भी जाएगा. एवरीथिंग विल रिमेन फाइन. बट जिसकी क्लैरिटी अच्छी है, जो इवेल्युएटर हो तो फिगर देखते ही कहेंगे उल्टा लिख दिया है. फिगर देखते पता चल जाएगा उल्टा है. तो ऊपर वाला क्या है? लॉन्ग है. राइट? क्यों लॉन्ग है? यू आर पेइंग प्रीमियम इन द बिगिनिंग एंड आफ्टरवर्ड ऑल्सो यू आर पेइंग प्रीमियम. इसका आप लोग मैट्रिक्स बना पाओगे आराम से? बहुत आसानी से बन जाएगा मैट्रिक्स. एंड सेकंड में आपको इसमें 3 ही एक्चुअली है, ये 4 पोजीशन 4 हैं बट प्राइस 3 है. तो टेबल 3, बिकॉज बीच में जो पोजीशन है, सपोज शॉर्ट बटरफ्लाई की बात करते हैं तो 2 साइड से शॉर्ट हो गए. 1 फर्स्ट शॉर्ट कॉल ऑन K1, सेकेंड शॉर्ट कॉल ऑन K3 एंड 2 लॉन्ग कॉल. तो 2 लॉन्ग कॉल में सीधा डबल ही तो करना है, करना क्या यार। प्रीमियम कितने हो जाएंगे, 3 अलग अलग प्रीमियम होंगे, बीच वाला प्रीमियम को डबल से मल्टीप्लाई कर देंगे, राइट। अब अगर प्रीमियम की बात करेंगे, कॉल की बात करेंगे, तो सबसे हेवी प्रीमियम क्या होगा, पहला होगा। सबसे मिनिमम प्रीमियम लास्ट वाला होगा, K3 पे होगा, डायरेक्ट। Because whenever we say K1, K2, K3, always keep in mind K3 will be bigger than K2 will be bigger than K1. लाइन पे ऐसे चलेगा, no confusion on that. Clear? So this is what you make it. Let's look here. Why I first talked about this before coming to box? Because in box what happens? Box K1, K2, K3, K4 may be sometimes called as boat. What is boat? बोट स्प्रेड कैसा होता है, बोट का अगर बटरफ्लाई को बोट कर दें, इसी को मैं चेंज करता हूं, यहां लिखता हूं एक प्राइस, 2 प्राइस, तीसरा प्राइस, चौथा प्राइस, ओके। 4 प्राइसेस, बीच वाला ऊपर में क्या है, इट्स अ मिडिल वन, इज द ओनली 1 प्राइस, हियर इट इज 2 प्राइस। शेप गौर से देखो, बोट की तरह लग रहा है, दैट गेट क्रिएटेड, ओके। आप इसमें भी उल्टा कर सकते हो, इन्वर्टेड हो जाएगा, ऐसे बोट उल्टा कर दिया गया हो। सो वेरियस स्ट्रेटजीज कुड बी पॉसिबल। हाँ, इन्वर्टेड में नहीं, अभी तो जो कोई शॉर्ट पोजीशन ये वाला है ना, ये शॉर्ट है ना, बिकॉज यू आर गेनिंग द प्रीमियम आउट हियर। सिंपल सी तरीका है, शॉर्ट पोजीशन मीन्स, याद कीजिए, बताया था मैंने पहले क्लास में ही ऑप्शन स्टार्ट करते वक्त कि यहाँ लॉन्ग और शॉर्ट नाउन है, वर्ब नहीं है, बोला था ना, ये नाउन है। और सब जगह लॉन्ग मीन्स बाई होता है, बाई मीन्स वर्ब हो गया, बाइंग पोजीशन को लॉन्ग कहते हैं, यहाँ बायर को लॉन्ग कह रहे हैं, राइटर को शॉर्ट कह रहे हैं, ओके। तो ये पोजीशन इस तरह से क्रिएट होता है। अब इस पे आप देखोगे वही K1, K2, K3 बाइंग है, यूरोपियन वगैरह वर्ड आप लिखो ना लिखो, बिकॉज इन इंडिया ओनली यूरोपियन इज अवेलेबल, नो अमेरिकन इज अवेलेबल, बट बाय definitions always it is better to explicitly write that, and it is going to be European. So what it says, a butterfly spread involves positions in options with 3 different strike prices. It can be created by buying a European call options with a relatively low strike price K1, buying a European call option with a relatively higher price K3, and selling 2 European call options with a strike price K2, that is halfway between K1 and K3. So now question is it talking about long butterfly or short butterfly? It is talking about long butterfly or short butterfly? क्या है ये? लॉन्ग बटरफ्लाई यार, जो पहला क्या बताया, जो टर्मिनल पे है वो लॉन्ग। अगर टर्मिनल पे आप लॉन्ग ले रहे हो तो लॉन्ग हो गया, टर्मिनल पे अगर शॉर्ट लोगे तो शॉर्ट हो गया। ऊपर में ही कह रहा है कि यूर बाइंग कॉल एट K1, बाइंग ए कॉल एट K3, तो दोनों टर्मिनल तो बाई है, तो लॉन्ग हो गया। लॉस से कोई लेना देना नहीं है, आपका पोजीशन टर्मिनल क्या है, टर्मिनल पोजीशन गिव्स यू आइडेंटिटी, राइट। सो एंड बटरफ्लाई, उसके बाद क्या है, एंड सेलिंग टू कॉल ऑप्शंस एट K2, halfway between this. Generally K2 is close to the current stock price, होगा ही मिड में होगा, एक लोअर एक ITM होगा, एक KTM होगा, एक OTM होगा, यही होना है ना। ITM का ऑलवेज प्रीमियम हाई होगा, OTM का प्रीमियम लो होगा, बीच में प्रीमियम में आसपास होगा इसका। मिडिल का मतलब एग्जैक्ट मिडिल जरूरी नहीं है कि हो। K1, K2, K3 में हम एग्जैक्ट मिडिल लेने की कोशिश करते हैं। और यहाँ पे बटरफ्लाई स्प्रेड लीड्स टू अ प्रॉफिट इफ द स्टॉक प्राइस स्टेज क्लोज टू K2। अब देखो K2 के स्टेज, अब एक कब बटरफ्लाई कब आपके लिए अच्छा होगा, व्हेन यू डिसाइड कि नीदर प्राइस विल गो अप नॉर प्राइस विल कम डाउन, इट विल रिमेन इन अ रेंज बाउंड एरिया, बटरफ्लाई विल बी बेटर ऑप्शन फॉर यू। Okay, that's the strategy. Better options will be there. A butterfly spread leads to a profit if the stock price stays close to K2, but gives rise to a small loss if there is a significant stock price movement in the either direction. Okay, very interesting part. Other way around also you can create it. If suppose you feel there is a very heavy movement in the market, but you don't know the direction of movement. Market is highly volatile. इसको हिंदी में कहते हैं मार्केट में उठा पटक बहुत होने वाला है. मार्केट में क्या होगा, बहुत ज़्यादा ऊपर जाएगा, बहुत नीचे आएगा, मुझे कुछ पता नहीं है. ये पता है मार्केट शांत नहीं बैठेगा, बहुत ऊपर नीचे होगा. जब डायरेक्शन पता ही नहीं है तो आप स्ट्रैटेजी कैसे डेवलप करोगे? तो दोनों तरफ से स्ट्रैटेजी डेवलप कर लो, जिसमें क्या होगा, छोटा सा लॉस के बाद आपको लॉस होगा ही नहीं, एंड दैट छोटा सा लॉस आप निकाल सकते हो, क्योंकि यहाँ आप 2 लॉन्ग कॉल ले रहे हो, 2 लॉन्ग कॉल दोनों साइड में है. इज इट क्लियर? और 2 शॉर्ट है, बीच में है शॉर्ट. आराम से स्ट्रैटेजी के लिए ऊपर प्राइस होता चला जाएगा, लॉन्ग कॉल आपको ऊपर वाला लॉन्ग कॉल फायदा देगा. Am I clear? That's the way you are protecting yourself. So it depends on what kind of market is going to be. It is therefore an appropriate strategy for an investor who feels the large stock price moves are likely. तो मेरे लिए तो likely unlikely दोनों बनता है. अच्छा, ये तो बुकिश स्टाइल है. I have already mentioned you how it is there. It's a go to box. Box has got this way. A box spread is combination of bull call spread with a strike price K1 and K2. Okay, box spread is bull call and bear call to bear put two together. So bull call spread and bear put spread, you two make two together. So K1 price, K2 price, two different prices we are going to make. So one is on this side, another is on this side. Make that conditions. It's a box spread is going to be there. In the box spread, whatever difference of the price will be coming up, K2 minus K1, is the ultimately differential, not more than that. Now, because what happens here, the payoff is always K2 minus K1. The value of a box spread is therefore always a present value of this K2 minus K1 to e to the power minus RT. E to the power minus RT is the discounting. Whatever the discounted value. K2 minus K1 is what? Always your strike is going to be 1 month, 2 months, 3 months hence. So whatever you discount it to present, that is going to be your net value is available to it. And ये बॉक्स का डिफरेंस है, बटरफ्लाई. ओके, वन मोर. This is slide is up to here only. Slide is not mentioning anything beyond this, but I have already given you one additional one that is called boat shape. Okay, boat shape is actually, or it's something like whatever 4 different prices are going to be set. Now I'll give you 3 more terms or 4 more terms which will be important, a kind of writing short notes, not written here, but it is very, very helpful. First one is called a strip, S-T-R-I-P. Second one is strap. Third one is straddle, S-T-R-A-D-D-E, S-T-R-A-D-D-L-E, straddle. And fourth one is strangle. Okay. First of all, again, this is a kind of a ratio spread. Do one thing. Just take a definition of it. Some of you should start with straddle because it's only one which will have a variation to make it 3 more. 4 products are there. So just take out and take the definition of a straddle. How a straddle is going to be there. Take out the definition of a straddle. And then we will talk about on your Google, look into a straddle, how it is your 2:1 ratio, it is going to be there. if it is called STRADDLE, straddle? You got? Anyone? Just read the definition.
A straddle is a trading strategy that involves options. To use a straddle, a trader buys slash sells a call option and a put option simultaneously for the same underlying asset at a certain point of time, provided both options have the same expiry date and same strike price.
Buy, call and put together. Okay? What is there? You are buying also, call and not selling. Look into that. Read very carefully, because a strategy has to be explained afterward. What is the first definition? You can sell, that sell straddle will be there. You can buy, but when you are buying both. You are selling both. What is that? Read it again. Sell कर रहे हैं. Clear? Means long straddle या short straddle होगा. ये होगा ना? नहीं, that is the feature that always we took, because it is not a calendar spread. So same strike price means here K1 K2 नहीं है, ध्यान दीजिएगा. If I am buying call option, long call is on 10,800, my long put is also 10,800. No, it's basically movement is not very specific what direction is there. Straddle. तो ऐसा करते हैं कि पहले ये 4 हैं. कितने हैं आपके पास? 4 टर्म आपको लिखाया है. तो 4 टर्म में आप पहला टर्म तो स्ट्रैडल हो गया, मैंने स्ट्रैडल से स्टार्ट करवाया. स्ट्रैडल में क्या हो गया? लॉन्ग कॉल लॉन्ग पुट, माने बाय कॉल. फिर से लैंग्वेज पढ़ दो आप लाउडर. कॉल और पुट है. रीड इट. हाँ.
To use a straddle, a trader buys slash sells a call option and a put option simultaneously for the same underlying asset at a certain point of time, provided both options have the same expiry date and same strike price.
Strike price and expiry same. सेम अंडरलाइन तो होना ही है. अब ऐसा नहीं है कि आप एक तरफ निफ्टी बाय कर रहे हो और दूसरी तरफ मतलब कॉल कर रहे हो और पुट किसी और पे करोगे, तो फिर वो एक अलग प्रोडक्ट आपका हो गया. दैट इज नॉट बेसिकली, लिंक इज नॉट देयर. ओके, मूवमेंट डिफरेंट हो सकता है, राइट. ये स्ट्रैडल पे आपने किया, तो इधर यू कैन गो फॉर लॉन्ग स्ट्रैडल. लॉन्ग स्ट्रैडल मीन्स यू आर बाइंग कॉल, लॉन्ग कॉल एंड लॉन्ग पुट. लॉन्ग स्ट्रैडल को लिख लो LC प्लस LP. दैट्स द वे फॉर्मूला यू डेवलप. LC प्लस LP, राइट. LC प्लस LP. शॉर्ट में क्या हो जाएगा? SC प्लस SP at K. K means single price. Okay, for same underlying, for same expiry. स्ट्राइक प्राइस सेम होगा. ऑल इज देयर. अब आप इससे थोड़ा डेविएशन है, स्ट्रैंडल में पढ़ो. स्ट्रैंडल क्या कहता है? रीड आउट.
Strangle is a popular option strategy that involves holding both a call and put on the same underlying asset.
आगे.
A strangle covers investors who thinks an asset will move dramatically.
नहीं, इसका मतलब इसने एक्सप्लेन नहीं किया है. स्ट्रैंडल इज अगेन, इट इज स्ट्रैडल का डेविएशन है. एग्जैक्टली. नाउ एट 2 डिफरेंट स्ट्राइक प्राइस यू आर टेकिंग. फिर से पढ़िएगा पूरा डिटेल.
An option straddle is an option strategy which the investor holds a position in both a call and a put option with different strike prices but with the same expiration date.
एक्सपायरेशन डेट चेंज नहीं किया, सिर्फ आपका अब क्या बदल गया? अभी क्या था स्ट्रैडल में? स्ट्रैटेजी सेम है लेकिन सेम ही प्राइस पे आप ले रहे हो. ना मोमेंट यू चेंज योर प्राइस, स्ट्रैडल विल बिकम स्ट्रैंगल. ओके, अब आइए स्ट्रिप पे. एक स्ट्रिप देख लीजिए, एक स्ट्रैप देखिए। अगर स्ट्रिप वर्ड ढूंढने में दिक्कत होती है तो स्ट्रिप ऑप्शन स्ट्रैटेजी कर दीजिए। यस, नो फाइंडिंग्स। strip and strap is basically a stacking, ratios बदल देगा। read carefully and loudly.
A strip option strategy is executed when the trader expects the underlying asset price to make a
Big move, yes.
is not sure in which direction.
Which direction?
The price will move. The trader buys a call and two put option.
Yes, ratio मैंने क्या बताया अभी? Ratio 1 call and 2 put option.
With the same strike price, so they will benefit from a big price on the negative side.
नेगेटिव साइड मूवमेंट। क्लियर? इसीलिए मैंने स्ट्रैडल को बीच में रख के पहले आपको एक जनरल स्ट्रैटेजी बताया, अब उसी के डेविएशन करके ये स्ट्रैटेजीज बन रहे हैं। और अब स्ट्रिप कर लिया तो स्ट्रैप भी कर लीजिए। स्ट्रैप इज ऑल्सो देयर, अपोजिट ऑफ स्ट्रिप। यस, स्ट्रैप अपोजिट है। अब अगर 2 कॉल और 1 पुट कर दीजिएगा तो स्ट्रैप बन जाएगा। Okay, so let's summarize the options. Now you have already viewed various option strategies are there. These option strategies ultimately decides about that in which market conditions what kind of a strategy will be adopted. For that you have to have first forecasting related to market. Depending upon nature of forecasting, you decide about your options strategy. So which strategy you will adopt, that has to be chosen, and what kind of gain loss has to be there, that has to be calculated. Though it is a kind of a concept, but mostly it will be numerical in nature. So numerically you have to solve, and the way price has been given in the question, it might be possible you will have, say, at 10,800, 10,900 price has been there, that strike price K1, K2 has been written, but afterward it is giving you information that say assume from 10,000 to 12,000 with a gap of price of 100 rupees, what will be the net position of yours? So what you have to make then in that case, generally one statement has been written. So you have 10,000, 10,100, 10,200, 10,300 till 12,000 you have to move. Long list you have to prepare, and you have to give that strategy. Okay. Similarly, what do you mean by butterfly? Okay. Develop a strategy. Why anyone will develop a strategy? Explain with the help of an illustration. Now it is so straightforward. Burden is not there to the teacher, that how you will be, preparing numerical just by writing 2-3 lines, but you have to illustrate. It has got a 2 help. Help number 1. First help number is there in the 2 help, that question paper is small, but answer you have to be written numerically. If you have not written you have not illustrated, marks will not be available to you. Clear instruction. Marks will be there only when you have given illustrations. Illustration means assume price is a strike price is this, price moves like this, this is the premium, and according that requires your clarity of the concept. Second, 2 student can't have the same example. If 2 student has got exactly same example with the same price range, with the same strike, with the same thing, marks will be divided on a 2 basis. If I give you numerical, it will be all the same. तुम्हारा क्या आंसर आया, तुम्हारा क्या आंसर आया. But if you take your illustration, you have to decide your illustration. So that's the way. And if you don't say, if suppose someone argues that there is no numerical question, I say you look minutely, it is every question is a numerical question. Marks will be given to you full only when with illustration. So option is over. Now there is a chapter called exotic options, which is again deviation from the options, and exotic options are we will keep it theoretical. Subject to that, time should be available to that extent. Otherwise, you can go through with the various deviations of it. It is bilaterally decided. Bilaterally decided means two can decide about it. Whatever options we were talking about right now, that is traded on the market. Now it is two party decides about options, and they decides any of, see, concept is not different. The only concern, different conditions you put it. You define it, you deviate it accordingly, and even so many other financial institutions who provide options to their client, they call it is their own one. It's basically they define it differently. Some of the important exotic options which you should study, like your Asian option, Bermuda option, look back options, okay. So many options are there. Approximately 100 plus exotic options are there. But 4-5 are important, or maximum 10 are important. 4-5 are very important, which could be like, asked in your examination question for short notes. So you can define and what happens in that. Okay. Suppose options start after a certain specification. Option starts at a certain K1 is there, but K1 is not exactly the moment it moved, it starts. Its start is different. Suppose we say, no, we will not give you the price, a strike price. How difference will be created? The spot price. I say no, spot price will not be the closing price. Rather, it could be average of a given number of days. So that kind of alterations could be possible between two parties, but it is not a tradable instrument. It is not a ETF. Okay, it is OTC product, and those OTCs you have to study, but that is very simple, theoretical in nature, and little on simply retaining with your brain is there. So I will be starting in the next class financial swaps. That's another very important chapter. So I'll cover swaps, and then I'll go to Greeks. I'll try to enter into Greeks in the very next class itself, after covering financial swaps. So thank you for the today class, and I expect from you, you will do your practice now. Basics of derivatives, forward, futures, options has been covered. Majority of your course has been covered for examination point of view, and financial swaps, one question complete will be there. That will also get covered. One question Greeks will be there, and ultimately you will have 7-8 questions to